have reached Madi with Straight Up Mortgage with Madi, and today we are going to be talking about escrows. Now, this is a mortgage statement or an example of a mortgage statement, and I just kind of wanted to look at it for a second. So when you have a mortgage statement, you see right here where it says property address, this is how you know what property is associated with a specific mortgage or a specific mortgage statement. When I first started processing, I would look at this address up here, and that's not necessarily the address. It just so happens to be in this case. But let's say if your borrower lived at one address, but they had another property that they owned, and there would be like a different address here. So their mailing address and whatever property that they may own, wherever it is, it would be a different property address here. But sometimes our eyes just kind of get pulled here. So I just kind of wanted to bring it back down here. Now, escrows. What are escrows? When you look here where it says current payment due, has a little breakdown of how this borrower is paying their mortgage. So it has this principal of $386. The interest, look how much interest this borrower is paying, $1,048.07. And then escrow for taxes and insurance, $235.18. For whatever grand total. They also have some sort of fees being charged. And then this is their grand total that they pay monthly. But can you believe that their principal is so low and their interest is so high? Just to show how sometimes you can be in a pretty tight mortgage, expensive long-term mortgage. But here it says what? Interest rate is 4.75. But this might be an ARM loan just because it says interest rate until. But this is neither here nor there because we are talking about escrows. What are escrows? I keep getting this question. So let's say you purchase your home. You have to pay your taxes, and you also have to get a homeowner's insurance policy, right? We got that understood from the order outs videos. Now, when you have either a higher risk factor, like maybe your DTI is higher, or your LTV, your loan to value. Your DTI is your debt to income ratio. Your loan to value is the LTV. I'll go over those for those of you that don't understand the concept of these ratios. But what I do want to explain here is when you're paying your taxes and insurance, there's a choice. You can either pay them outside of your mortgage, or there's sometimes a choice, right? Where you'll get a direct bill from the county and you pay your taxes. You get a direct bill from your homeowner's insurance and you pay it. Or it gets lumped into your mortgage payment, and your lender or your mortgage company will pay your taxes and your insurance on your behalf. However, you are getting billed for it here, like you see. So let's say you're purchasing your property. You obtain your HOI or your homeowner's insurance, and you have to pay your taxes. Now, when you're escrowing, sometimes depending upon when your taxes are due, how much they are, what county it is, the closer will collect a couple of months of escrows in advance to make sure that they have enough, that the lender has enough to pay your taxes. At the end of every year, every borrower that escrows, they get this escrow breakdown where it shows, where the lender paid, how much the borrower's been paying to the lender in regards, just to settle the politics so the borrower can understand that the lender is not taking their money. The lender is only paying their taxes and insurance. because the lender doesn't have to take any more of their money, especially in this case where the interest rate is so high. Okay, so taxes and insurance. We're understanding escrows, hopefully. So escrows, you're escrowing when your lender is paying the taxes and insurance on your behalf through your monthly mortgage payment, where you pay a fraction of your taxes and insurance to the lender for the lender to pay your taxes and insurance for you. Again, why do people do that? Well, for one, let's say me, one of the reasons why a person would do it is like kind of laziness in a way. Like, I don't feel like paying, extra bills outside by myself, Like, I don't want to have to like pay directly to my HOI the full $1,000 for my policy premium, nor do I want to pay for all of my taxes, out of my own budgeting pocket, But if you escrow and the lender's taking care of it, then it's like, okay, one less thing to worry about, or two less things to worry about because they're doing it. But if I'm a person that's on top of my finances, I probably will want to pay it myself. And so if my loan officer said, okay, do you want to escrow? I'd be like, no, I don't want to escrow. I can pay my bills on my own. I don't need your help. Now, in the case where you have a higher risk profile, your LTV or loan to value might be too high. Again, those are times where you would have to escrow. Like, if you want to get this mortgage, you want to get this loan, you have to escrow because we don't necessarily trust that you'll be able to pay on time. I hope that this video was beneficial to you, for you, and I will see you on the next video. Thank you.